So what I'm going to talk about is we're going to do, I made a little time-lapse movie of how the market actually reacts to an event. So I'm a big fan of visualization because I feel that if there's an effect that we can quantify and we can measure, we should be able to see it. You know, they say a picture's worth 1,000 words. So if we can see that effect, we might gain some insight. We might decide how we want to analyze the data, how we want to measure it. So you know, we talk a lot about the importance and the impact, and I thought it's good if we just actually, you know, just watch it. So a brief background on my company and myself. OneMarketData was founded in 2005 as a software company to provide high-performance software to the financial industry. So our flagship product is the one-tick software, and it's capable of recording every real-time piece of data coming out from a market data feed, all trades and quotes. But you can use it to store any kind of time series data of any frequency. It can be daily, monthly, anything. So we started off as a software company. We're now also a data company. We offer a data product called OneQuantData, and that's our global historical equity research database. And for the people here familiar with CRISP, I know we just heard a paper made off of CRISP data. It's a very similar product, except it also includes global stocks and the US Bulletin Board. And that's how we got partnered with Wall Street Horizon. We went looking for a source of earnings calendar data because that's one of the most requested pieces of data that we have. And now just 2 weeks ago, we launched our OneTick Cloud, which is our hosted tick data platform for people who are not OneTick software users. They can go to our website and they can purchase custom tick data sets. So the tick data I'm looking at today, you know, could be purchased from that. And our software users, they can just point their software directly to our hosted servers. So I think a lot of this is just pretty common knowledge for the people in this audience, but if we have any visitors, when we talk about market data, what are we talking about? We have most commonly the trades. That's every price and size of a trade that took place in the market. And then around the market, the trades, we have the quotes, and that's the highest price any buyer is willing to buy at, and the lowest price any seller is willing to sell at. And that gets aggregated across all the venues during the normal open trading hours, and that's the commonly published number. So when you're on your Bloomberg, that's what you're seeing at the top of the screen. But then beyond that, we have order books. So for every trading venue, there's a whole range of prices and sizes that people are willing to transact business at. So it's worse prices, but more liquidity. And that's what I wanted to look at. So I haven't seen a lot about how did these events affect that liquidity. And I thought it would be nice to kind of dive into that and see what happens. So I picked Apple as a case study. We're getting a lot of earnings announcements now. And Apple just announced on Monday. And so I could tell from the Wall Street Horizon data set that they announced at 4:30 p.m. And I went back 2 years in the data and found that they consistently announce at 4:30. And that's a very important piece of data to have. So we want to know not just the day they're going to announce and if it's going to be before the market or after the market, but once it actually comes out, we want to know when it actually happened so we can go back and correlate that with data. So people are very interested in it now. It's a member of the Dow. And so I'm going to look at the order book from NASDAQ, 10 levels deep, and we're going to see what happens when that announcement comes out. So this is a chart just showing what the order book looks like. So on the x-axis, we have our prices. And the height of the bars represents the size that's being bid or offered. So I colored the bids blue and the asks red. And the only reason there's some space between these bars is I've zoomed in so much. If you look at the price scale, those bars are just 1 cent apart. So we've got a very tight market. I could look beyond 10 levels. For a very active stock, we have literally hundreds of levels if you look at the entire book. But that's getting pretty far away from where the trades happen. And where the blue and the red meet up, that's our inside quote, and that's where the activity is happening. So if we zoom out, now we're on about a $2 scale on the prices, and you can see how tightly those 10 levels of bids and offers are clustered. And you can see that tiny little gap that's the spread. Normally they'll be either right next to each other or just 1 cent apart. And we're right before the market closing, 2 seconds. And we're going to zoom in. I'm cutting the tops of these bars off because I want to provide some detail when the market closes. So at this point, we're looking at 0 to 2,000 shares on the y-axis, and we have a price range of $2. So after the market closes, we transition to after-hours trading, and you see there now we've widened a lot. So our spreads have widened, our liquidity has declined a lot. So all the day orders have expired, the closing auction has happened, and now the market's starting to trade in the after-hours mode. So it's a little chaotic around that transition. Now we're going to zoom ahead to just before the announcement at 4:30. So there's 30 minutes of after-hours trading, and as the time goes on, what we see is the spreads start to narrow pretty significantly. So we were spread all over this graph. Now we're tightly clustered, and there's some decent size. It's not the kind of size that we had while the market was trading in the regular way, but it's still pretty good. And I've zoomed out here, so this is what we're going to look at before the event happens, and I want to give some space so we can see these changes, but just before it takes place, things get pretty quiet. So the market is really consolidated along a consensus of what it thinks is going to happen before this announcement comes out. And there, the market's starting to react. So you can see instantly the spread is starting to widen. This is only 2 seconds after 4:30. And 12 seconds later, market's all over the place. So again, this is a $7 range on this graph. So we have our bids way down here, our asks out here, and you'll see how active this gets when we look at the movie. But as time goes on, then things start to consolidate and come back in. It starts tightening up. The market's digesting that information. We're 30 seconds past the announcement. Now we're a minute, almost 3 minutes. And so you can see it's a nice kind of orderly market. We've got this spread. It's much wider than normal trading, but that's expected after hours. You're going to incur the higher transaction costs. And then there we are 10 minutes after the announcement. So now let's go, and we're going to just actually watch this. And I think it's just very instructive to actually see it happen. So we're going to go and just start our playback here, and just keep your eye on the clock. We're going to just watch what happens around the close, and we're going to jump forward and watch what happens around the earnings announcement. So here's our book, and you can see the levels are changing as liquidity is being taken and added, and the two sides are kind of pushing against each other. It's like a little fencing match almost, and we've zoomed out here so we can get a little bit wider picture. And we're getting very close, 20 seconds to the close. So I'm going to zoom in now on this x-axis, and just keep your eye on the clock as we hit that close. There we go. So that's what happens to our liquidity when we get into that after-hours trading. You can see how wide it's spread, and you can see how there's quite a lot of activity. There's quite a lot of orders being placed and removed. And as we go on, we're starting to consolidate. We're going to jump ahead now about 15 minutes. And you can see it's starting to tighten up. So we're keeping the scale the same. But we can see that we're getting some pretty good liquidity, some things that are actually being cut off from that 2,000 share scale. And we're only about a minute away from the earnings coming out. And I'm going to zoom out one last time. And as we go into the final playback, just keep your eye on the clock, and Apple's going to publish at 4:30 p.m. So the market's really consolidated, really kind of waiting, and there it goes. And now the trading is very active. The spreads temporarily got very wide. You can see they're pretty wide. There's a lot of activity, but we're at 2 minutes now. So this effect is very quick, but it lasts for a while. So you don't necessarily have to be a high frequency trader to take advantage of this or be involved in this. The market takes some time to digest the information. And now we're 8 minutes past the announcement. And you can see things have tightened up significantly, and they're not moving around as much. So the market's kind of reached that consensus on where the price should be post an announcement, and there we are 10 minutes after the announcement. So I hope this kind of gave some insight into what we're really talking about when we talk about the impact of events on markets. And just to conclude, we get those very fast reactions, but the effects linger for a while. So the reaction, it takes a while to digest that information and that data. We can look beyond returns and prices. We can look at things like liquidity. That might be very important in relation to events. And just some ideas. Maybe we want to measure that spread, measure that skew between the bid and the ask, incorporate it into a trading cost model perhaps. So I hope that was useful. And thanks Wall Street Horizon for providing us with the data. And that concludes the movie section of the presentation.